Hi, folks. This is Daniela Cambone, and welcome back to StansberryInvestor.com. Before we start today's segment, though, I want to just share with you a report that Stansberry Research has put out that I highly recommend you check out. With most investors going about life investing and retirement planning as if nothing unusual has happened to our financial system, not realizing the repercussions of the 11 trillion that's been pumped into the US financial system in the past 18 months alone, it's particularly a good read at this moment in time. At least 4 billionaires have stated publicly that Americans aren't paying enough attention to this development. And now a former Goldman Sachs banker says sooner than most people think, millions of Americans will potentially be pushed down out of the middle class, out of private retirement, and out of a decent life based on independence and privacy into a collectivist nightmare he calls financial lockdown. So find out how to protect yourself, your money, and your family with a free copy of his new report. In it, he'll show you the 4 steps he recommends you take immediately. You simply have to go to www.wakeupcall2021.com to get a free copy of this report. Again, it's www.wakeupcall2021.com. Get your free report today. It's a great read. All right, that said, let's get to today's show where we are talking gold. The gold bears in full control here ahead of the Fed. We will find out what is affecting the market today with Egon von Greyerz. He is the founder and managing partner of Matterhorn Asset Management. Egon, nice to have you on the show. It's been a long time coming. Nice to have you to join us.
Nice to be with you, Daniela. You know, the times are so exciting now. So there is something to say every day, and we will be wrong half of the time, but at least in the short term. But I know long term, we know what's going to happen, so that's easy.
Well, amen to that. And I'm really hoping, because you are a gold expert, and I'm hoping you can help make some sense of what is happening. And we're going to get into the nitty gritty of it. But the gist of it is, you know, with everything, you know, this financial backdrop that we have, gold technically should be higher. And I just want to pull up a recent tweet of yours here. You say, a huge component of the record-shattering bull market bubble has been stock buybacks, financed by artificially cheap debt and ample liquidity. It is quite clear why any talk of a substantial Fed taper is, in the long term, a farce. Now, this is a different way of looking at things, because many would argue we are in a taper tantrum. You say no. Why?
It's not possible, Daniela. I am not a short-term investor, and I'm, as your viewers can tell, I've been around for a while, and experience tells us that we shouldn't worry about what the Fed says or what the Fed indicates any day, because they're always wrong. They're always behind the curve. They're always wrong. But the market's focus is on the minute-by-minute basis. We focus on the long term, and that's why we are in gold, of course. What we are looking at is risk here. The risk is very clear. We are looking at a world where debt has grown exponentially. Just take at the beginning of this century, global debt was, well, let's say 100 trillion. Now it's 300 trillion. And there's the same with US debt, European debt, EU debt, etc. So, and that's not stopping just because everybody thinks the Fed is now going to tighten. They can't afford to tighten. This debt and this deficit is not going to stop. You know, stock markets are just insane. They're not reflecting what's happening in the economy and the world. All they're reflecting is a lot of money being flooded into the markets, and they're reflecting liquidity. Remember that we are now looking at markets which are on a historical basis more overvalued than any time before in history. So, you know, I can't see how they can afford to taper, because the US economy will crash. And if they taper temporarily, they will reverse it immediately. So that's, and in any way, it's not going to be in the short term. The other thing is interest rates. You know, a lot of people think that interest rates will still stay low forever. If the Fed can decide, yes, they will stay low forever. But the Fed will not be able to decide in the long term, because the weight of the debt will actually make the bonds crash at some point, and the Fed will not be in any position to actually stop that. So we're looking at a lot of factors here which will be out of the control of the Fed, in my view, and therefore I don't think we should worry about any tapering of any significance in the next 6 months or longer.
Okay, out of the control of the Fed. So that said, Egon, you've touched on very important points here, which leads me to my next question. If you can help make sense why gold is below $2,000 an ounce with the money printing and liquidity in abundance. What is keeping it down?
Well, again, you see, I don't worry about the shorter term here. We have been into gold since 2002. And we went into it because we saw the risks in the world as unacceptable. And we saw that the debts and the deficits were going to go up exponentially. And therefore, we decided that gold was the best way. Physical gold outside the banking system is the best way to protect against these risks. And we bought gold at $300 in quite a big way for ourselves and for our clients. And we haven't changed our mind since. And we've seen gold then going up and down to since 2002. We've gone up to 1,000, down to under 700, and then up to 1,900, and down again a few hundred. And these small movements here are totally irrelevant. We know that gold will reflect the continued destruction of paper money. We know that the world cannot stop printing money. They're doing it now, but short-term gold doesn't always reflect the actual printing of money. It moves in its own way. And of course, there is also intervention with gold. We see that coming in quite often. But the paper gold market is insane, totally insane. Doesn't reflect what's happening in gold. So, as you know, the price is set in the paper market, and the paper market, the gold price that we're looking at now on the screen has nothing to do with the real price of gold. When gold goes down, we don't see a single seller of physical gold in our market, and that's the real market. It's just a paper market, and it's primarily COMEX market, which is relatively, not that big in relation to the total gold market.
Well, okay, and I hear what you're saying, that you've been in gold a long time. You look at gold long term. I get that. But I hear what you're saying, that whatever happens, it happens in the market right now in this moment doesn't necessarily translate into the gold price yet. But short term here, talk to me about the dollar story. In your opinion, how much is the strength of the US dollar weighing on gold right now in this moment?
Yes, so I started my working life in Switzerland in 1969. There were 4 Swiss francs 30 to the dollar. Now it's about 90 cents. And that tells you what's happening to the dollar. And that's the same in every currency. Since 1971, the dollar, and if you measure it against real money, against gold, the dollar has lost 98 to 99% in all currencies. And the trend is so clearly down. Now, these small wiggles that we're seeing now, a little bit stronger dollar for a few weeks or whatever, that means nothing. The trend is down, the trend is strongly down, and nothing is going to stop that. That's what history tells us. No currency has ever survived. The dollar has lost 98% since 1971, as I said, and it's only 2% left to go to zero. That's going to happen. That's going to happen in the next 10 years, less probably, maybe 5 years. And remember, for the last 2%, that's 100% from here. So we're going to see the dollar, but not only the dollar, it'll be all currencies. They can't all go down against each other at the same time. So they will take turns and be stepping. But nevertheless, we are going to see that final fall now in the next few years, sadly.
What about, okay, how about this angle? Do you think there's a loss of interest in gold right now from institutional investors? Are assets like Bitcoin hurting gold? Are they taking a chunk away from the market?
Yes, probably. Some of the speculative and opportunistic money is going into Bitcoin because they're all interested in short-term performance and quarterly performance. Nobody's looking at long-term wealth preservation. We are not interested in Bitcoin. It's nothing to do with wealth preservation. It might be a wonderful speculation. It has been for a lot of people. Bitcoin might go to $1 million, or it might go to zero. That's such a binary investment that we wouldn't touch it. And in any way, electronic money has nothing to do with wealth preservation. It might be a method of payment. I don't think it will be either in the long term, because if it's too successful, the central banks will stop it, because they cannot see a currency competing with their own currency. And we know that they are all very likely to issue digital currencies in the next 5 years or so.
Right.
And so yes, it is affecting, Bitcoin has affected on the margin, but that's more the speculative money. The long-term money that are into physical gold, they're not worried about. Our clients, for example, they're not clients who would buy Bitcoin. Mm-hmm. They wouldn't be interested. So I don't think you should compare the two, but investors do, and investors are interested in short-term returns. The institutions are always late in their decision making. We've seen a few institutions, not a handful, let's say, going into physical gold now. But once they realize that inflation is for real and is here to stay, they are going to have to inflation protect their assets. They're not going to buy a massive amount of gold, but today only 0.5% of world financial assets are in gold. If that went to 1% to 1.5%, that wouldn't be enough gold in the world.
Now that's an interesting point you bring up. That could it be that investors have not yet bought the inflation story yet, and that's why gold is not rising above 2,000 or levels that people really want to see here. So that said, when you say the inflation story isn't going away, how do you see it unfolding? Do you see a hyperinflation scenario happening?
Yes, I do. I believe that for quite a long time. I mean, because that is always the end of a monetary era. And every time in history, currency has died. And we are now, in my view, at the point when these currencies that we see now, the dollar, the euro, the yen, all of them basically, are in the end game, which means that they are now finishing the race to the bottom. They have the final 2% left, as I said. So that therefore, yes, that obviously, what has happened until now is that all of this money printing has stayed within the banks, or within a very few investors who've spent that, hasn't gone to the consumer, hasn't got into the main economy. Therefore, we have seen no velocity of the money that has been printed. That's now coming. I lived through the 1970s, and I lived in the UK then. And I remember we had average inflation in the UK in the 70s for about 7-8 years. We had about 15% average inflation. My first mortgage in the early 70s was at 21%. This is what happened, and that wasn't even hyperinflation. I think the money printing we're going to see in the next few years, because that is the only tool that central banks have to save the system. But they're not, of course, a debt problem can never be solved by more debt, but that's the only way they know. I'm sure they find methods of writing off the old debt and creating a new debt instead, and forgetting about the old dollar, and there'll be a new digital dollar. But that's just kiddums, has nothing to do with the reality. You cannot get rid of debt. If you get rid of debt, the assets that are backed by that debt will also implode. And that's what I see happening. In the end, the debt will actually disappear. And so the assets will implode also. That's why we're going to see assets falling in real terms, not in hyperinflation terms. In real terms, assets could fall, in my view, at least 90%. Stocks, bonds, property, they're all going to fall by 90% in real terms. People say that's not possible. It's not possible they're going to fall so much. Remember, in the 1929-32, the Dow went down 90%. by 90% in that time, and we didn't have anywhere near the amount of debt and money printing that we are seeing now worldwide. It's never happened before. Remember that globally, this problem has never happened before. It's always been one country or one smaller area. It's never been the whole world. The whole world is in the same mess. There's no one there to save the world.
Egon, what kind of time frame are you looking at where we'd see some sort of U.S. equities implosion?
I will happily admit that my timing has been off so far. I'm right on the longer trend, i.e., the problems that we're seeing, the debt problem. But to me, after 2009, the world should have collapsed, the financial world. The banks were on the verge of imploding, and the whole financial system. But they skillfully managed to print and guarantee another tens and tens of trillions. And they saved the world. I think we're now getting to the stage when it's not possible anymore. I know forecasting short-term timing is a mug's game, so that's why we're not really interested in timing when we look at preserving wealth. We're more looking at just covering our risk. So it doesn't matter to us if the stock market falls today or it falls in 3 years' time. But nevertheless, what I'm looking at now from a point of view, both fundamental and technical factors, I think it's quite imminent. If imminent is this week or in the next 3-4 months, I don't know. But I'm looking at short term. There's a high risk now. But as I said, from my point of view, I wouldn't be in the stock market now anyway. I think you should now get out of the market and protect yourself and try to preserve your wealth. Because remember, if the assets go down and the currency in which you measure the assets go down, you won't have much money left.
So is gold the only asset you use for wealth preservation? Do you like the other metals? Are you in silver, platinum, palladium?
Yeah, so if you talk about metals, yes, primarily, gold is the king of metals, and especially for wealth preservation. So we are using primarily gold. I think at this level, silver is very interesting also, because you have the gold-silver ratio at 75 roughly. It's been up to 120. Now it's down 75. The historical average is 15. So silver could outperform gold quite substantially in the coming months, but it's also so much more volatile. So we think that if investors want to sleep well at night, they should hold more gold than silver. But I have some allocation to silver. That's fine. The other metals are so small, we don't really consider them.
On the gold front, do you just like physical? What about miners? We know U.S. listed gold miners have shed 1/5 of their market value this year. Would you be looking at adding miners here?
So we as a company, and also therefore, my view has been since we started 2002, that stick to the simple thing, the physical. Now there are, and of course, privately I have some mining stocks, but we have for our clients we recommended just simply to focus on one thing, and that's physical. Now I think mining stocks have a tremendous opportunity here, and I think they will outperform. The good ones will outperform the physical metals. But of course, from a wealth preservation point of view, you have other risks. You have then the market risk, custodial risk, a political risk, etc. You have the risk of the whole financial system in which you're holding these stocks. And if something happens to the financial system, you have difficulties getting hold of your stocks if you don't hold them direct, if you don't have direct investments in them. So therefore, I think that there are tremendous opportunities in these areas, but it's just not an area we focus on, and we are pure wealth preservationists and experts on that.
Egon, let's wrap with this, because I'm sensing you hate forecasts, but how can I not ask you this question? I understand you're in gold for the long term, but our audience, they love numbers. So on a 6-month horizon, where could we see the gold price headed here? Will we stay in this consolidation mode? Will we have a breakout? What are you sensing?
Well, in 3.5 months or so, we'll have Christmas. I can forecast that without any problem.
Unless they cancel.
Yeah, well, they could very well. The trend is up. I think we are finishing a correction now in gold. We're finishing in technical terms, you're finishing at which looks like a cup and a handle. I don't know if you've heard of that, but that's basically, so we're finishing the little handle now, and that means that after that, you're going to break out. Now, fundamentally, gold will go a lot higher. So there's no use. I don't even need to put the fundamentals forward because absolutely certain, just like it has done for 5,000 years, is always, since no currency has ever survived in history, gold has always outperformed all currencies in history. Now, I think gold is going to start a major rise at some point in the next few weeks, let's say. Now, if stocks crash during that time, then gold could come down a little bit further. I don't think it'll be a major correction like in 2008 because they're not the same. There's not the same hot money in gold now as there was in 2008. So therefore, the people are not going to liquidate gold to the same extent as then. So I think that my forecast price target that I've had is not a forecast. The price target I've had since we started investing in gold in 2002 was $10,000 in today's money. That's not a forecast. I think that is the least it will reach. And I think, you tell me what the dollar is going to be worth in 1 year or 2 years time, and I'll tell you what gold will be worth. So basically what I'm saying is we value gold with the wrong measurement. We value gold in currencies which are weakening by the day. You should really value gold. Gold really should only count in ounces or grams. But of course, people are not interested in that. They want to hear an amount. And that's what you want too. But gold really, it's irrelevant because everybody wants to hear what gold's going to be worth in money that is going to continue to decline over time dramatically. So therefore, it's totally irrelevant. So I can tell you that gold will be 10,000 in today's money, or it could be 100 million or 100 billion or 100 trillion, like in the Weimar Republic. What does that mean to everybody? Nothing, because if we get hyperinflation, it means nothing because we're only looking at a currency that is actually disappeared. So you really have to look at purchasing power. Gold has over time always maintained purchasing power. Today, gold is, as I'm showing in some graphs in my articles, gold is as unloved and undervalued today as it was in 1971 at $35 and in 2000 at $288. And it's also as undervalued in relation to US money supply as at those times, i.e. it's the same level now as 71 and 2000 when gold was $35 and $2,000. So gold is massively undervalued at this point, and therefore that will soon correct itself. There's no question about it. So, I call in a recent article that's just come out, I call gold the sleeping beauty investment. Gold is something that you can now put away for 100 years. And when you wake up 100 years later, you know that it's at least maintained its purchasing power and probably done a lot better than that. And even not, we don't have to wait 100 years. My time horizon is a lot shorter than that. That's why people shouldn't worry about the price. If they're interested in preserving their wealth against assets that over the next, let's say 5-10 years, we take a longer horizon than I think it will be, then I think gold is an incredibly, probably the best insurance they can buy as long as it's physical.
And we've heard this argument time and time again with gold that yes, slow and steady wins the race. I think that many gold investors are just, again, not to bring it back to Bitcoin and not to compare them, but when they see the returns coming in on the crypto side and they're looking at their gold portfolio, they'd like to see a little bit more action here. And again, I hear what you're saying. It's a long-term play, wealth preservation. It's not a speculative play.
But can I just say, so in 98, 99, everybody was an expert at tech shares, the whole world, everybody, housewives, gas pump attendants, everybody, they are total experts. And they were making fortunes every day as the NASDAQ went up and up and up and up. And 2-3 years later, they'd all lost their money. They'd seen the quick moves, they'd double their money. And then, as you know, on average, the NASDAQ fell by 80%, but a lot of stocks disappeared totally. And, this is what risk is all about. We're looking at risk. We're not looking at, short-term gains and instant gratification, which the whole world is looking at today, because it's been so easy. You buy a house and you make money, and you flip it and you get a bigger house and you make more money. You buy a stock and you sell it, and it goes up and up and up. That's not for real. If you take historically over time, inflation has never been more than 1% for hundreds of years. It's just what has happened in this last 100 years since the Fed was created is an anomaly. And that's not going to continue. We're going to go back to the norm, but in order to go back to the norm of slow growth, we will also first have to have a massive correction, and that's going to be very unpleasant for the world. People probably think that I'm a pessimist. I'm not. I love life. I'm a great optimist. I'm just someone who, you might not believe that, but I'm just someone who focuses on risk, Daniela. I understand. I try to understand risk, and when risk is unacceptable, I'd rather protect that risk than be in for the last move up. We say that we have 10% left in markets on the upside, and we have 90% plus on the downside. I'd rather than be protecting my downside and then be in for that last 10%.
Last question. Just want to understand your philosophy, because when I speak to other gold experts, they will argue that we're actually already in the midst of a gold bull run. In fact, we've been in one for the past 3, 5, whatever years. Do you agree that we're already in a gold bull run? What inning are we in? You speak
yes,
that.
Yes.
Well, I'd like to understand your.
Yeah, absolutely. No, we actually were incredibly fortunate to more or less hit the bottom or near the bottom of the gold market. So we went in 2002. Gold was $300. It had been as low as $250 in 1999. So we went in at $300. So we rolled the gold market up to the 2011 top in dollars, and which was 1920. And now we've had a very long sideways correction, very boring. Everybody's got tired of gold. Nobody's interested. But in my view, that correction finished, depending on how you measure it, around 2015, 16. And we are now in the next bull run. And I think what happened since 2016, 17, we now started the final bull run, and we've just seen now since August last year. So we were up then to 2000 or last year, and we're now seeing a correction again. I think we're very soon going to start the next bull run. So yes, we are now starting a very important and probably the fastest leg of the gold bull market. How long that will last, I don't know, but it's probably going to last a very long time, the way I look at the currencies and the way I look at the world economy and the debt.
All right. On that note, Egon von Greyerz, thank you so much for joining me here on StansberryInvestor.com today.
A great pleasure to speak to you. Thanks a lot.
And thank you for watching. We will have much more for you. In the meantime, don't forget to sign up for premier content you can't get anywhere else at DanielaCambone.com. That's it for me. Thanks for watching.